Hello, everyone. Welcome to today's session on distribution planning. We're going to be talking about the TSP distribution options and why it is important to have a strategy when you're in retirement distributing your wealth to make your ends meet. So, with that being said, let's talk a little bit about the TSP withdrawal options. Most people have a plan to head into retirement and use the TSP as their withdrawal tool in retirement. And let's talk about the options that you have and get crystal clear on these. So, the TSP gives you the option to withdraw up to 4 times a year while you're working for those that are 59 and a half. And then after that, there is no limit to your withdrawal. Okay. No limit to your withdrawal. Additionally, you have the ability to toggle between Roth or traditional balance when you're making those withdrawals in retirement. That's super useful. That allows you to pull from pre-tax dollars or after-tax dollars so you can strategize what's best for you. Additionally, there is a required minimum distribution that the IRS will set forth, which is generally around 5% of the TSP traditional balance, starting at age 73 or 75, depending on where you land in age. And then lastly, on that point, Roth TSP is exempt. It does not participate in the distribution. Lastly, you can manipulate your payments between monthly, quarterly, annual, and you can make changes at any time. So notice that there is no option here that is, can you select from the options that are your funds in the TSP to withdraw from? For instance, what I mean is, can you implicitly decide that you want to withdraw from your G fund or your F fund, especially if the market is down that year? Do you have the ability to do that? And as of now, there is no ability to do that. So if we kind of look at the L funds as an example, let's assume that you set up this allocation for yourself, which is the 2030, and you set that up for yourself individually, meaning you pick those funds. You put 34% in G fund, you put 6% in F fund, you had 31% in C fund, 8% in S, and you had 21% in I. And let's say that you asked for a withdrawal from the TSP. What are they going to do? They are going to sell off the funds proportionately. They're not going to give you a choice. Well, sir, would you like this all coming out of G fund, or would you like this all coming out of the S fund or C fund? They're going to sell it off proportionately. And where this matters is if you're in retirement making withdrawals. Because if the market were to open up in a downward spiral versus an upward spiral, it's going to make a major difference on your account. So the example that we show here in the green section is $1 million TSP with a $50,000 drawdown, meaning withdrawal, which is a 5% drawdown. Okay. We're giving it an average return of 5% over the course of the entire retirement span, but we're showing the first 3 years being very positive in the market. There's a nice lift to that portfolio. And by age 68 in this example, this person's account is at $1.45 million, even with a $50,000 withdrawal. Now, over on the right side, we show the same average return, the same $50,000 drawdown, but instead, this individual has started off with 3 down years, starting with a 25% down year, okay, followed by a 14% down year while withdrawing funds. And you can see the big differences in these balances. The account is heading south quickly, even though at the end there are some great returns, in their 79th birthday and 80th birthday, as opposed to over here in green, the 77, 78, 79, and 80th birthday are not so hot. The account has already had some great generous returns out the gate. So this is how you can find yourself in trouble, okay? And what we recommend is to consider investing your money based on a timeline of when you're using your funds, okay? We recommend that you do a deep dive into what exactly you're spending in retirement. You can do this by just taking an analysis of your expenses versus your income. What is your pension? When is your Social Security being introduced to your cash flow timeline? What are your expenses? What are your debts? What is your healthcare going to cost? How much are you vacationing? How much is your tax payment? Then you will arrive at how much you're using in your first year of retirement, let's say without Social Security, right? From there, you can create an entire timeline of how much funds you will use leading up to when Social Security or other income is being introduced and leading to less withdrawals on your portfolio, okay? This sets up what we call a bucket approach. What we want you to consider doing is being very intentional with how you're allocating your TSP or retirement funds in retirement, right? What is going to be used within the first 3 years needs to be in something conservative, but it needs to be something that you can utilize specifically, not by having all of your funds coming out proportionately. So in this example, we're going to recommend something like having a couple $100,000 in your short-term bucket. If in the first year of retirement, you're using 160, followed by 100, followed by another 100, we want $400,000 in this short-term bucket. And that's what we're going to utilize, especially if times get tough in the economy and markets contract. We want another 3 years from year 4 to 6 in this midterm bucket. That can be corporate bonds, other higher producing income investments, maybe dividend funds that aren't as risky as, let's say, the S&P 500, right? Your C fund, which will be in that long-term bucket, that will fill up that short-term bucket when that short-term bucket's gone. So again, this is how you want to consider allocating your TSP in retirement. You want to be as intentional as you can possibly be and set aside these allocations, and whatever is long-term, 7 years plus, this stuff can remain invested in the market, right? Without really worrying about the year-to-year fluctuations in your first couple years of retirement because you've built that short-term. So these are the differences between a TSP being used in retirement and a retirement account outside of the TSP, such as an IRA, where you can control these buckets and the outflows and specifically choose on one to withdraw from, which is why you set up the allocation in the first place. So appreciate you attending this video. Feel free to sign up for our one-on-one session right there in the middle, and we'll look forward to seeing you in future videos here on our channel.